Welcome to PhillipCapital's Weekly Market Watch. In the month of May this year, China's stocks entered the bear market after the government boosted measures to curb loan growth and the soaring property prices to prevent the world's third-largest economy from overheating. Reports are saying that the China economy is declining. Should investors stay out of China? Today, we have Mr. Liang Shiping, investment analyst from Phillip Securities, to tell us more. So, Shiping, what is your overall outlook on the China's economy?
I think it's an overstatement to say that the Chinese economy is declining. Yes, China will be undergoing a cyclical slowdown in the near term, but that's perfectly normal in the context of the development on a growth story. The private and public sector in China invest massively in infrastructure construction and capital spending over the past decade. The question is, do they need it or are they overspending? The total capital stock per capita in China is probably only about 20,000 compared to United States is about 100,000 to 200,000. With a big proportion of rural area in mainland China itself still underdeveloped, a huge amount of capital construction is required. That being said, investment in fixed assets such as factories and the railway network account for 45% of China's GDP in 2009, which is higher than any major economy in history. One example is the high-speed railway, which cost the government 2 trillion yuan, by far the most expensive engineering project in Chinese history. These mega projects are very sensible investment for the long term, and they boost the economic growth for China moving forward.
What are the underlying domestic risks you see in China?
I think two domestic events are likely to slow down China's growth. Firstly is the China property market, as we see prices continue to rise at 12.4% for the month of May. However, long-term housing underlying demand in China is enormous. The Chinese government projected a total of 300 million people moving from the countryside into the cities over the next 20 years. There will be continuing real demand for affordable housing in the cities. It is only the question of increasing the supply of public and low-cost housing for this group of immigrants. Secondly, is on the Foxconn pay rise, which has sparked local governments to raise the minimum wages for the Chinese workers, and there will be concern on surging domestic inflation. But I'll prefer to argue that with wage income improving substantially, growth in China consumer spending will be strong, and China will be able to reduce its reliance on the export sector moving forward. To sum up my 2 points, I think nobody knows how big China actually is. Look at the steel industry and you will understand why. Researchers talk about overcapacity when the China steel production capacity is at 150 million tons. Today, that figure is 650 million tons, and domestic steel consumption is 600 million tons, and it is still growing.
Do you think it's the right time to invest in China?
I do think that recent declines in China equities are overdone, and further tightening measures such as interest rate increases are already priced in. The Shanghai Composite valuation is at 18 times reported earnings, almost half the 37 multiple we saw during its 2009 peak on July 31st. The China equities valuations are down by a third in 5 months, and it will be a good opportunity for investors to hold on to high-quality stocks for the long term. Unit trusts are good tools and one of the cost-efficient way in doing so.
Thank you, Shiping. That's all we have for you today. Tune in next week for more market updates.